This is the next global financial crisis. I'm your host, Steve Metre, and thanks for joining me today. In our lead story today, the fire sales are back as experts are now predicting property prices could crash by 40% or more. And this is coming at a time where we're now seeing the beginning phases as banks are dumping buildings, and they're not taking a small haircut. They're taking huge losses to unload these buildings. And what we're going to see is the biggest crisis in commercial real estate that's going to rival the global financial crisis. And these losses are going to spill over into the residential real estate market and are going to completely wipe out the small and mid-sized regional banks who are you about to see are major lenders in this space. But before we get to that, you may remember from last week, our friends over at EdgeTI, they have now announced their stock is DTC eligible. It's trading as of today under the symbol UNFYF. We told you to watch out for this. It's now eligible, UNFYF. There's going to be a big media blitz coming next week, so keep that in mind. Let's go to Zero Hedge, where we picked today's story up with the headline, "What are older office towers worth than the new era?" As second San Francisco office tower sells for a whopping 70% off original listing price. Now, those of you in the real estate market, if you're looking at this headline, there's something that you immediately think about, and it's called comparables, 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 because if you have a transaction at 70% off your asking price, it tells you you just reset the entire market in San Francisco. And if you're in another major city, you're looking at that transaction. It may not be in your region, but you're thinking if their price can drop 70%, then mine can drop significantly as well. And you start to see the domino effect here. As one building transacts lower, you're eventually going to see other buildings can transact at a lower price. Then this puts the small and mid-sized regional banks who are carrying a massive amount of commercial real estate debt in dire consequences, because it's going to force them to write these loans down. And the problem is they have no margin to do that. And when that happens, we're going to see a crisis far worse than the GFC. There were no transactions because no one knew what anything was worth. The San Francisco's office market has morphed in just a few years from being one of the hottest office markets in the U.S. with a vacancy rate of 7% in 2019. Remember, this was back before the pandemic, and some of the highest rents in the U.S. to being put on ice by working from home. About 33%, get this, 33% of all office space is now on the market for lease, worse than even Houston, which for years was the worst office market in the U.S. So not only do we have prices plummeting here, but the problem is you see this massive amount of vacancy, and workers, people want to work from home. They want to do the hybrid work schedule. And all of a sudden, what you saw was office space at max capacity, 7% of it just available, now 33%, and prices plummeting. And again, the bag holders here are the banks. And if you think about it, we've talked about, Blackstone, who has this big commercial real estate REIT that you can't get out of because it's closed in. Well, you start to see why investors want out of this space, because previously office buildings only went up in value. There was huge demand. Rents continued to rise. It was a great investment. Today, now everyone's wondering, how do I get my money out before the bottom falls out? So now there's a second deal in about a month, though the sale isn't closed. Wells Fargo found a buyer for one of its office towers in San Francisco. The Wells Fargo purchased that tower back in 2005 for $108 million, listed it for $160 million last year, but pulled the listing after receiving bids reportedly below $40 million. The deal is done with, they don't know who the buyer is, for about $42.6 million to $46 million, or around 120 to 130 square feet. That would be 71% below the original asking price and nearly 60% below the purchase price in 2005. So now you can see that anyone who's holding a building in that area, just watching this transactions go through, and is watching their net worth outright plummet. And what you're going to see is over the next 3 years, we're going to see a massive adjustment in the commercial real estate space. Unless something changes in the economy that drives workers back into the office, which, as we know, nobody really wants to do. But if something changes, and something will need to change, otherwise there's going to be a huge giant hole in the commercial real estate space, and the banks are the ones who are going to be in big trouble. The first tower to find a buyer in the new era of working from home and office footprint reduction had been the Union Bank headquarters, that too in San Francisco, which changed hands in early May at a 75% discount off the original listing price in 2020. So now we're seeing the buyers are sitting back saying, look, keep lowering your price. We're not going to pay top line price here. The price of Wells Fargo went from $120 to $130 per square foot, while the price of Union Bank was $200 to $225. Now you can see older office towers, which are in every major city, just took a massive cut in value. This is a big problem for the banks and even a bigger problem for investors. Neither the Wells Fargo Tower nor the Union Tower involved defaults, foreclosure sales, and huge losses for creditors because they were owned by the relative banks. There were no hapless CMBS holders involved that would lose their shirts. The towers did not serve as collateral for debt, and both properties have been owned by the banks for many years to use as their offices, but the banks, like most other major companies in the area, are shrinking their office footprint, and in doing so, establishing benchmark prices. And that's the key thing here. These transactions went through with just the banks eating the loss themselves because it was their corporate office. But imagine, what if there was a foreclosure sale? What if there was delinquencies that led to defaults? What if there were bondholders or investors? What you can see, and you're going to find this out, and over the next 3 years, what we're seeing right now is going to have a massive impact in this space. It's going to be outright devastating. As we find a new poll of half of major corporations plan to cut office space as commercial real estate turmoil rages on. So we're already hearing from major companies saying, look, we don't need all this space anymore. We thought we did. We're running these hybrid work schedules. Our employees like them. We might want to bring them back, but we're finding out there's a lot of pushback from them. In turn, we don't need as much office space, making this problem even worse. A few weeks ago, Goldman revealed the most accurate reading of the current commercial real estate market, pointing to a 25% plunge in office property values. Adding more to this nightmarish outlook is the new Knight Frank poll showing that major corporations expect to reduce global office space footprints over the next several years. And as you'll find out in a moment, the next several years are horrible. Bloomberg said the poll of 350 real estate leaders at international firms found half of the largest companies with total workforces over 50,000 employees are expected to cut their office space footprints by 10 to 20% in the next 3 years. And that's only part of the problem that's going to hit over the next 3 years. I can show you that in a moment, but this all points right back to the biggest lenders in the commercial real estate space. And remember, regional banks begin imploding in March. We noted that the commercial real estate nuke goes off with small banks accounting for 70% of commercial real estate loans. This is a huge amount of money. We know these banks now are hemorrhaging. They have no margin for error. As soon as they have to start writing down these loans and taking losses, it's going to be a wipe out event. You're going to watch their stock prices plummet. The government's going to have to come in. Perhaps even banks like JP Morgan are going to get even bigger and bigger as they swallow up these banks. It's going to be, as I said, a nightmare scenario. But one thing that shouldn't be imploding right now is your trading account. With our report CTA-Timer Pro, we've been talking about this tech rally that many people said, hey, I missed out on that. But our report said you should start buying here. And if you missed it, it said buy this pullback down in here. And now many of you are asking is, when is this going to give you the signal to cut out of the positions? I'll show you when it triggers, because we already had one subscriber reach out to me today and said, look, I've canceled my other reports. This one's so easy to use and so much better. And he said it's giving him much better trades than he saw before. And here you can see it, January 9th, the machines were deeply short. We showed in your report, it was short covering, giving your first signal to buy. Here's that pullback on March 15th. The machines were back buying again. What's cool about this report is it runs a historical overlay. It tells you what securities are down in very low levels. All you have to do is run your screens on them once you see which ones are at that low point and place your trades when you're ready. $30 a month, a link in the description below, because now let's look at what's coming over the next 3 years that's far worse than the reduced usage of office space to begin with. Interest-only loans that help commercial property boom. Now, according to the Wall Street Journal, they're coming due as landlords face a $1.5 trillion bill for commercial mortgages over the next 3 years. Nearly 1.5 trillion in commercial mortgages are coming due over the next 3 years. Many of the commercial landlords are on the hook for the loans, are vulnerable to default in part of the way their loans are structured. Now keep in mind, and this is important to understand, the risk is at the banking level, because the way these big property developers or property managers run their businesses, let's say they have 5 buildings. They isolate each building and firewall it off in a separately held LLC or corporate structure. That way, if they need to default on one, they don't lose them all. Now, the banks, they have no problem with this structure. As you should probably imagine, they ought to, because when you see how this is going to go for the banks, it's not going to be pretty. Unlike most home loans, which get paid down each year, many commercial mortgages are known as interest only. I know you find this shocking, but this is how it works. Borrowers make only interest payments during the life of the loan, with the entire principal due at the end. Now, why would this happen? Why would you do this? Well, one, if you're the borrower, this is a great deal. Number two, if you're the bank and you believe the commercial real estate prices, which you might remember from the global financial crisis when we said about rental or residential real estate, they believe commercial real estate prices only go, you got it, up. Typically, owners pay off this debt by getting a new loan or selling the building. Now, steeper borrowing costs and lenders' growing reluctance to refinance these loans are raising the likelihood that many of them won't get paid back. Of course, the problem is the lenders can't lend against them because the financial conditions are tight. They've done that. We talked about that in yesterday's show. As many banks, fearful of losses under pressure from regulators and shareholders to shore up their balance sheets, have mostly stopped issuing new loans for office buildings, as office and some mall owners are facing falling demand for their buildings because of remote work and e-commerce. Interest rates have more than doubled for some type of commercial mortgages, as analysts and property owners are saying, all validating that eventually rates will have to come back to zero when all these dominoes start to fall. So you see what we're looking at is now the perfect storm for another crisis. Fitch Ratings recently estimated that 35% of pooled securitized commercial mortgages come due between April and December 2023 won't be able to refinance based on current interest rates and the property's income values. While many malls and hotels face high default risk, the situation is particularly dire for office owners. And of course, this, according to Managing Director at CoStar, estimates that as many as 83% of outstanding securitized office loans won't be able to refinance if interest rates stay at current levels. So again, you're going to see all these bondholders take a hit. You're going to see the Fed forced to go back to zero. There's no way over time they can keep rates up when you have 3 years of refinancing coming, when values are plummeting and demand is crashing. A rise in defaults could ripple through the commercial real estate market, no kidding, by forcing distressed sales and pushing down property values. It could also hit regional community banks that are heavily exposed to the sector in a big way, forcing them to write down the value of commercial mortgages on their books and set aside more cash for losses, which neither of them they don't have the ability to do. They can write them down, but they don't have the cash. They've already tapped out their Fed credit lines and all that other available government loans. They are in a position where they cannot stomach any more pain, and according to the next article, it's going to get worse. As commercial real estate has taken a beating, but recovery may be slow for one big reason. Investment volume in commercial real estate fell off a cliff last quarter. According to CBRE, transactions plunged 57% in the quarter versus a year earlier to $78 billion, the lowest in at least a decade if pandemic quarters are excluded, with deal making led by apartment industrial buildings that remain investors' good graces for their more stable incomes. So we see investors are running away from them, but that's not it all. According to the RCA Commercial Property Price Index, property values overall fell 8% in the first quarter year over year, led by apartment buildings with a drop of 10.3%. And all this is doing is validating more pain for the banks, and you can guess what's coming next. And if you said delinquencies, you got it right. As late payments on commercial mortgages are now piling up as higher rates and weakening property prices bite into the sector, and commercial multifamily property owners that were late on payment for 30 days or more have already defaulted on their mortgages and had their property seized by a lender rose to 3% in the first quarter of 2023. That's up 1.1% from the previous quarter, which many of you say, well, that's not much. But remember, we're at the beginning phase of this, not at the end. As higher interest rates, meanwhile, have influenced the cost of borrowing for mortgages to move higher, the increased cost of borrowing have weighed on commercial property prices, with Morgan Stanley warning in April that prices could crash by as much from 40% from their peak, and that would be a wipeout scenario for the small and mid-sized regional banks that are holding 70% of all these loans. There's no way. They don't have the cash. They don't have the ability to absorb these losses, and we know, based on how these loans are structured, that the borrowers will simply walk away. And Wells Fargo CEO says there will be losses from U.S. office loans. To put it mildly, he's got it right. And we look city by city, we look property by property to look at our exposures, and I would say there's no question that there will be losses, he said. If you're reserving conservatively, which none of the small and mid-sized regional banks can do at this point, then you've de-risked the financial impact of the company. If you can see, he notes that Wells Fargo has less than 6% reserve coverage in his office portfolio. Because of that, they're not really at risk. But if you think these small and mid-sized regional banks have 40% margin in their buildings, they don't, not even close. They're far away, and that means any marked drop in prices is a wipeout event for the banks. It will just be a domino into the next crisis, and as I said, it will flow into residential real estate and then to the banks, and then the Fed's back at zero with every emergency type of bailout that you can possibly imagine. And one space that's giving us all the validation we need from today, we see, look at the crude oil. Now the inventories were down only 450,000 barrels, not that much, but look at this Cushing, which feeds into gas prices, up 1.7 million barrels. Distilled stocks up 5 million barrels. This is jet fuel. Now keep in mind, we're coming out of the holiday, going into the summer. Now a lot of schools are out. We should start to see these draws. People head on vacation. Gasoline inventories, 2.75 million barrel increase. All the saying is what we've been validating is the global economy, the U.S. economy is slowing, and there's no way that they can stop the big crash coming in commercial real estate. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.